What is Bitcoin and cryptocurrency? Bitcoin is the first and most well-known cryptocurrency, created by an anonymous entity known as Satoshi Nakamoto. It was introduced in a 2008 white paper titled Bitcoin, a Peer-to-Peer Electronic Cash System. The main idea was to create a decentralized digital currency, enabling peer-to-peer transactions without the need for intermediaries like banks. Cryptocurrency refers to digital or virtual currencies that use cryptography for security. Unlike traditional currencies, cryptocurrencies operate on technology called blockchain, ensuring transparency and security. Timeline of Bitcoin and cryptocurrency. 2008, Bitcoin white paper published. 2009, Bitcoin network goes live with the release of the first Bitcoin software. 2010, first real-world transaction using Bitcoin, 10,000 BTC for 2 pizzas. 2011, Bitcoin reaches parity with the US dollar. 2013, Bitcoin's value exceeds $1,000. 2017, Bitcoin reaches an all-time high of nearly $20,000. 2020 to 2021, massive adoption by institutional investors. Bitcoin hits a new high of over $60,000. 2023, Bitcoin remains the most valuable and widely recognized cryptocurrency, though it faces significant market volatility. Let's talk about some of the pros of Bitcoin and cryptocurrency. First, decentralization. It operates without a central authority, which reduces the risk of government interference or manipulation. Next, transparency. All transactions are recorded on a public ledger, also known as the blockchain, which is accessible to anyone. And of course, security. Advanced cryptographic techniques make it extremely difficult to counterfeit or double spend. Moving on, there are even more advantages. Lower transaction fees are generally observed compared to traditional financial services, especially for international transfers. Then, there's accessibility. Bitcoin and other cryptocurrencies provide financial services to the unbanked and underbanked populations globally. Lastly, the potential for high returns. Early adopters and investors have seen significant returns. But it's not all sunshine and rainbows. There are some cons to consider. Volatility is a major issue. Prices can fluctuate dramatically, leading to potential losses. Regulatory uncertainty is another concern, as governments are still figuring out how to regulate cryptocurrencies, creating an uncertain legal environment. And finally, security risks. Despite advanced security, exchanges and wallets have been hacked, resulting in significant losses. What is blockchain? Blockchain is the underlying technology that enables cryptocurrencies like Bitcoin to function. It is a distributed ledger that records all transactions across a network of computers. Each block contains a list of transactions and is linked to the previous block, forming a chain. This ensures that the ledger is secure and immutable. Key characteristics of blockchain. 1. Decentralization. No single entity controls the entire blockchain. It is maintained by a distributed network of nodes. 2. Immutability. Once data is recorded in a block, it cannot be altered without altering all subsequent blocks, which requires consensus from the network. 3. Transparency. Transactions are recorded on a public ledger that anyone can view. 4. Security. Cryptographic algorithms secure the data, making it resistant to tampering and fraud. Cryptocurrencies rely on blockchain technology to operate. Blockchain provides the infrastructure for recording transactions. Every transaction is recorded on the blockchain, ensuring transparency and security. Additionally, the decentralized and immutable nature of blockchain ensures the integrity of the cryptocurrency network. Blockchain uses consensus mechanisms, like proof of work in Bitcoin, to validate transactions and add new blocks to the chain. In summary, Bitcoin and other cryptocurrencies use blockchain technology to enable secure, transparent, and decentralized digital transactions. While they offer numerous benefits such as lower transaction fees and financial inclusion, they also face challenges including volatility, regulatory uncertainty, and environmental concerns. Cryptocurrencies are traded on various platforms including cryptocurrency exchanges, Online platforms like Coinbase, Binance, Kraken, and Bitfinex, where users can buy, sell, and trade cryptocurrencies. Peer-to-peer platforms. Platforms like local Bitcoins and Paxful allow users to trade directly with each other. Decentralized exchanges. Platforms like Uniswap and SushiSwap that facilitate direct cryptocurrency transactions without an intermediary. Trading methods. Spot trading, buying or selling cryptocurrencies for immediate delivery. Margin trading, borrowing funds to trade larger amounts, amplifying potential gains and losses. Futures and options, derivative contracts that allow traders to speculate on the future price of cryptocurrencies. Arbitrage, exploiting price differences between different exchanges or markets. Steps to trade cryptocurrency. First, choose a trading platform, select a reputable exchange or platform. Next, create an account. Sign up and complete necessary verifications. After that, fund your account. Deposit fiat currency or cryptocurrency. Place orders. Use market orders to buy or sell at the current price, or limit orders to set a specific price. Finally, store your cryptocurrency. Transfer your holdings to a secure wallet for long-term storage. Limited supply. Bitcoin and many other cryptocurrencies have a finite supply. Bitcoin, for example, is capped at 21 million coins. This scarcity can drive up value, especially as demand increases. Decentralization and security. Cryptocurrencies operate on decentralized networks that provide security and transparency. Utility and adoption. The utility of cryptocurrencies in various applications, from remittances to smart contracts, increases their value. Store of value. Bitcoin is often compared to gold as a store of value. Speculation and market sentiment. Cryptocurrency markets are heavily influenced by speculation, innovation, and technology. Blockchain technology, which underpins cryptocurrencies, is considered revolutionary. Cryptocurrencies are traded on various platforms using different methods, and their value is influenced by factors such as limited supply, decentralization, utility, adoption, speculation, and underlying technology. Despite volatility and risks, the potential benefits and innovations associated with cryptocurrencies continue to attract investors and users worldwide.